Hey guys, John Paulamy here, Actionable Intelligence. Today is Saturday, December 14th, and this is the weekly market update. The disclaimer, as always, anything that you hear or see on this podcast or video is not to be taken as investment advice. I am not a registered financial advisor. I cannot give you personal financial advice. Please do your own due diligence. It's your money, it's your responsibility. Okay, just wanted to start up here. We've talked in the past about the basically how the U.S. market is in a bubble. Uh, I think that many people understand that, but a lot of people also say that, well, it's deserving because the U.S. is so much better than the rest of the world as an investment destination. I mean, a lot of excuses are made in bubbles of why the valuations don't matter. Again, one of the main things I think that's driving this is passive fund flows, the money that comes in every week or to Fidelity and Vanguard and these places where they just go into S&P funds. And we've seen that this is continuing passive fund flows for years, up to the tune of, sometimes hundreds of billions of dollars a year. And so that, to my mind, is creating a situation where, the money has to go somewhere. So it's all of these S&P indexed funds are market cap weighted. So whatever has the largest market cap, the money goes in there. For example, a thing like Nvidia, we talked about this before. If I told you you had to invest $1 million in Nvidia and hold it for 10 years, or Japan or Germany, all the stocks there, I mean, what are you getting? You know what I mean? Is it certain that Nvidia is going to be um, in the same position it is now as a leader in chips forever? I highly doubt it. And yet it's worth more than the entire stock markets of entire countries like Japan and Germany. Well, somebody would make the argument, well, those places aren't doing very well, and so it's warranted. And Nvidia is on top of the chip world for AI, and we know all the arguments as we went over them before here. But um, again, price is what you pay, value is what you get. And so my philosophy is I just do not buy things that are extremely overvalued. Does that mean that there will be periods of underperformance? Yes, there will be periods of underperformance because in a bubble era, these things, if you're not invested in them, then you're not going to, uh, your returns are going to be below the average. But again, we're talking about the entirety of an investment career here. Because you catch a bubble, the people that made a lot of money during the dot-com bubble. Do we hear about them now that why isn't the guy that made all this money during the dot-com bubble, I'm talking about regular retail investors, why aren't they interviewing him 24 years later and he's compounded his wealth? Because it doesn't happen like that. People get lucky, people are in the right place at the right time. It happens. I've talked about it. And for periods of time, they outperform. Uh, th- the trick is, can you compound wealth consistently over time? And I think the only way to really do that is via buying things that are undervalued. Um, this is working and continues to work, and it will continue to work until something comes along to reverse the flows out of these passive investments. You see active funds are actually negative. So there's no merit, there's no uh, weight given to being an active manager because just buying the index outperforms. And so that's working. And so you can't begrudge people, right? You can't say, well, this does you're just swimming upstream. And so I don't think it's a new era. It's a factors of, you know, a bubble, these passive flows, which we have never seen before, where even other people are saying the amount of The amount of passive fund flows now is distorting the market terribly around uh, price discovery. You know, so again, this is going to work until it doesn't work, and then we'll see. But if you're going to put money in Nvidia, we've also seen that these things get so expensive that they they you have so much future growth built into the stock price that even when they have a very excellent quarter, the stock price still goes down. It gets to the point where no fundamentals can justify the price. So this is something we started talking about with the recent Gordon Rosenzweig Q3 resource market commentary when there was a discussion in there about has the Permian peaked, has U.S. shale peaked? Inevitably, it will, as all oil fields do. It's not a never-ending cornucopia of supply. But I think this is interesting because um, you see the breakdown between the three major fields. You see how the Permian really has, like even back to 2015, you see that um, the Eagle Ford and Bakken were almost similar in scale, and just how much that the Permian has expanded and really carried the weight, really, of all basically non-OPEC. I think the expansion of the Permian has accounted for 80 to 90% of non-OPEC production growth and new supply. Without this expansion of this area here of supply, then the world would have been in serious trouble. So, um, I think another thing I wanted to point out while we're talking about this is, you know, we can't actually know when the peak is going to come. We can look at the information. They're not going to announce it, but you see little clues here and there, and I'll talk a little bit more about that in the subsequent slides. But I think you're going to see happen, at least with the Trump administration, it's going to morph away from um, drill baby drill, I think is what everybody's thinking now, but it's going to be more of a barrels of oil equivalent. So it'll be like, no, we didn't raise oil production by 3 million barrels a day during our tenure, but we raised it by 3 million barrels of oil equivalent. So you can obviously take natural gas or electricity or these other things, and you can convert it to barrels of oil equivalent. And I think that's what they're going to do because I think it's going to become very apparent to the administration that you can't raise oil production. You can't force people to drill uneconomic wells. They're not going to do it. And I say that, the era of drill baby drill was prior to the pandemic, where you see the expansion of the Permian, but that's kind of went away because there's no money made. I mean, I don't even believe that there was any even positive cash flow during that time. It was a gold rush mentality with a lot of private equity money and a lot of Wall Street money that came in and overpaid for acreage. And we know the whole story. And now that's morphed into, all those managements basically, a lot of them or most of them went away during the um, pandemic or post-pandemic oil crash and were replaced by more sober-minded investor focused, where investors were saying, we want to see some of the benefit of these cash flows or of this production. We don't want you just to company build and drill for the sake of drilling. We even saw where incentives, I talked about this a long time ago, several years ago, where incentives were skewed. People were being rewarded for raising production. That's what your stock options were based on. It didn't matter. So, if you are incentivized incorrectly, then you're going to end up, with a drill baby drill mindset because your compensation's tied to raising production, not profitable, not cash flow growth, not returns to shareholders, but to just raising production. So that's what they did, and the money was available. And so coming back into play, the Biden administration really didn't clamp down too much on its growth. Um, but we're getting to the end. We're getting to geological constraints is the argument. And so like I said before, I remember reading in USA Today, the McPaper, the dumbest newspaper out there with the most, you're looking at everything from 50,000 feet. There's no real, it's just a cut and paste thing. Where they were talking about, they're gonna raise, this shale boom's gonna raise to, 25 million barrels a day of production, and we're going to be the new Saudi Arabia and all these things. So yeah, we've had this great abundance of oil and gas growth, but it's not going to go on forever. We already see like these two other fields have peaked or they're plateaued, and they'll eventually go in the decline. And the same thing will happen to the Permian, and then OPEC will then reemerge as it always has, as being able to have the most market share and being able to set prices. You know, we could get into deep, deep discussions about, does Saudi Arabia actually have, 6 million barrels of spare capacity or 4 million barrels of spare capacity? But like I saw in a recent interview or debate, one of the debaters pointed out just because somebody has capacity doesn't mean they can raise production to that level and hold it there. It was pointed out there were several times in the past where Saudi Arabia has had calls on production and has been able to raise production, but for short periods of time. They just can't raise production to 11 or 12 million barrels and hold it there. So, what is the real true, you know, capacity that's sitting there, reserve capacity or whatever you want to call it, of OPEC? We don't really know. And I don't even think they know what they could really do in a pinch. But, what I think you're going to see, well, I'll get into this later on as we go through these slides. So here's a tweet that I think is tying back to what GNR said and some other folks have said. It says, while U.S. shale has made remarkable efficiency gains, it's becoming increasingly clear that we can't grow meaningfully with 300 Permian oil rigs. And given the current forward curve and rig count, there is little growth in U.S. shale for next year, talking about 2025. Current U.S. implied oil production is between 13.25 and 13.35 million barrels per day. This is well short of the 13.6, 13.7 most analysts, including the IEA, estimated earlier this year. It's time to recognize that efficiency gains don't solve all problems. The two problems we truly have are geology and price. Drill, baby, drill is a catchphrase for NGLs and natural gas, not so much for oil. And that kind of ties back to what I think is going to morph into the administration's way of saying they met their goal and saying, well, we didn't really mean 3 million barrels a day of actual oil. It's of oil equivalent, NGLs, natural gas, electricity, nuclear. We're going to dump it all in there and convert it and call it good. Because it's simply, you can't make, Chevron and Exxon and Oxy and all the rest of these people just say, we demand that you go out and just, drill because we have this political goal that we put out. We want to get oil prices down and get gasoline prices down. It's just not going to happen like that. So I do think that they could have some success with getting energy prices down because I think there's a lot of opportunity there, overall energy prices, but they're really going to have to finesse it. And I think that's what they're going to do. And there's a good possibility that if we do go into we peak in 2025, like some folks are saying, and the oil price actually moves higher, this could be a big problem for this administration because they've promised lower energy prices. So again, we've talked about Chevron, 1 million barrels a day in the Permian, reducing capital spending for 2025. Chevron Corp expects to spend two-thirds of its $13 billion in 2025 upstream spending budget to develop its U.S. portfolio, reducing its year-over-year spending in the Permian Basin. So there you go right there. One of the largest producers in the Permian isn't going to increase its spending. In the U.S., Chevron has earmarked 4.5 to 5 billion to the Permian Basin, a reduction from its 2024 budget. The company said production growth is being reduced in favor of free cash flow. In October, the company said it was targeting Permian Basin production of 1 million barrels a day by 2025. Permian Basin production guidance for 2025 has not been provided. So I want to get to another slide talks about this. So this is the weekly energy tidbits I get. This is talking about the Permian Plateau for Chevron. It says, is U.S. shale tight? Is U.S. shale tight oil to peak in 2025. Chevron moves to Permian plateau in 2025. And their commentary here, we can't help wonder if people were missing the forest for the trees because they don't link Chevron's Thursday release on reducing Permian capex and growth rates to CEO Worth's Q3 call Q&A, clearly stating they were going to move the Permian towards a plateau in 2025. And that implies they will then focus on keeping that flat for as long as possible. It makes sense, as the higher the level of production, the faster the treadmill to keep up and stay flat. It really feels like they are telling us they have reached their comfort level of where they can work to keep Permian production flat for years. So not declining from here, but not growing from here either. Earlier this morning, we posted a link. Is lower 48 shale tight oil finally peaking in 2025? So they get into some of the things they say. And I go back to what the CEO of Chevron said. As we move towards the 1 million barrel a day mark next year, we will begin to shape our profile there a little bit towards a plateau, and we'll really begin to focus on free cash flow. Chevron clearly says it's moving to peak plateau Permian production in 2025. Does this point to others doing the same in the Permian, i.e., moving to hold flat plateau instead of growth? Permian has been the lower 48 shale tight growth region. So if Permian is only flat, does that mean lower 48 shale oil in total will start to be down a little bit? If so, positive for oil with forecasts of peak oil demand getting pushed further out. So let's go back up to, so again, we're not going to know until the information comes in. Um, is this move by Chevron and other players just a manifestation of mostly price or geology? That's really the argument. The argument that Gorin and Rosenzweig make through their analysis that they've done of each well in these areas, and using AI and some other things, that it's a geological problem. The wells that you're drilling now are not as good as the ones that you drilled originally. We all know about the steep declines there and how you have to run faster and faster. It's a Red Queen's race um, to stay flat on production, much less grow it. The other thing that you will have the other side of the coin, where folks that are bullish will say, well, technology's gotten better, the efficiency gains per foot of well distance has got better and better. But ultimately, it comes down to, if oil goes to $100 a barrel, let's say, for example, will all these folks start drilling again? And then we would see an uptick in production. So the question again, are you limited by price or geology or a combination of both? It remains to be seen. But I am becoming more and more bullish for oil in 2025, just because um, everybody hates it so much. Very few people can find a bullish argument for oil. Sentiment is extremely negative. It's as negative as it's been since COVID. And so that's at least got to make you interested. I'm not saying go out and, mortgage the house and buy, but it's something that piques contrarians' interest. So this is from a Raymond James presentation, oil market sentiment at all-time lows. That's what we're talking about. This is oil market sentiment now at all-time lows, as you can see. This is the positioning of traders. I mean, you're at levels, if you go back to COVID lows here, these are key bottoms in the past. This is net positioning, is still the best marker for bottoming in crude. Are we at, if we're at all-time market lows? But, the argument can be made by the bears and say, well, you deserve to be down here because you deserve to have sentiment terrible. You deserve, because the market's oversupplied and demand's peaking, and drill baby drill and China EVs and blah, 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 blah. And I'm not discounting that. That's why I say it's very difficult to forecast the oil price. I will say, though, that even at these low oil prices, there are, in my mind, tremendous values out there among some companies. You have to remember, during this whole period, even before COVID, people were already getting their balance sheets aligned, paying down debt to the point where their break evens were so low. There's quite a bit of value in a lot of these companies that are, even at these current oil prices, able to produce oil and have a decent, low double digit, 10, 12% free cash flow yield, which a lot of these companies are pushing back into share buybacks. And so if you're able to do that at the current oil price, I mean, there's people that are saying oil's going to go to 40. Well, if oil goes to 40, then it stays there. Well, then that's a problem. But is it really going to do that? Has oil demand really peaked? I don't think so. We're setting new records all the time. So here's why they say Raymond James is talking about in this presentation why sentiment is bad, concerns about weakening Chinese oil demand and potentially other weakening global economies. Again, we've talked about the Chinese oil demand for transportation, gasoline and diesel. It looks like it's rolled over because of the more and more use of LNG to replace diesel trucks and electric vehicles. But petrochemical demand is continuing higher. So yes, the rate of growth in China has slowed, but there's still demand growth in China, mostly coming from petrochemicals. Okay. And then you say, well, other weakening global economies. Well, Europe is in a recession. Okay, no doubt. China is weak, but we're talking about, as I'll talk about later, they've talked about re-stimulating, and other places around the world, demand's growing. And we have, as I've pointed out, we're in a money fest, liquidity cycle where most central banks around the world are cutting rates. So that's on the other side of the argument. Concerns about EV encroachment on ICE vehicles. I think EVs peaked personally in a lot of places. I think you're going to see more hybrids. I think is going to be kind of what Toyota said many years ago, and I think they're going to be proved right. You'll see, I think EVs will continue to be sold. I mean, they're big in China and places where the government's pushed them, but you know, unless you're going to let BYD and the other Chinese manufacturers flood the U.S. with cheap electric vehicles, I don't see U.S. manufacturers being able to supply them, and they're all losing money. So I'm not sure. We may have reached peak EV encroachment on the ICE market, but we'll see. Then there's concerns about rising non-OPEC supply from the U.S., which we've just talked about, which is basically when you say from the U.S., you're talking about the Permian Basin, Guyana, which is continuing to grow, but they're talking about getting to 1 million barrels a day, which they're almost there. I mean, they're just going to keep doubling every year. That's not realistic. Brazil, Canada, etc. And then concerns about Saudi, i.e., OPEC, flooding the market with capacity. They supposedly have this 4 to 6 million barrels a day of capacity that's offline. They recently extended bringing that back till April of 2025. So we'll see. Conversely, what I think is, the Trump administration's coming in. There's been a lot of euphoria around drill, baby, drill, energy policies. I think that, like I explained earlier, what I think is going to happen around that's going to get a little bit more nuanced than just 3 million barrels of additional oil production. I think that sanctions on Iran are going to go back into effect almost immediately. They're already starting, I believe, even during the Biden administration. But anyways, that's going to come back big time. So again, um, it's very difficult to game or handicap this. What I go by is the sentiment. If everybody hates something, I'm going to take a look at it. Now, I've held a couple of the oil stocks I have in my portfolio, and they're cash flowing great. I have a company down in South America that's I have several companies in South America that are double-digit dividend returns at current oil prices. I have a Canadian producer that is plowing 100% of free cash flow back into buybacks and dividends. They've paid down their debt from about $3 billion to less than 500 million. That was the goal they set. And so they're, long life Canadian oil sands reserves, 50-year reserve profile. Those are the kind of things I'm looking for because I don't believe demand is going to peak anytime soon. And with everybody pulling back on investment, and if we do in fact get to a point during 2025 where we do in fact plateau or peak on the Permian, then I think that we will see oil prices move higher. Again, this is a developing situation, and we'll have to see. So we have those kind of questions out there. Is Permian peaking? Is does OPEC really have the spare capacity, and can they bring can they and are they willing to bring it back? Or do they understand what's happening and see that they'll be able to set the mark, and at some point later in 2025 there'll be a call on OPEC. So we'll see. We just have to watch. But when sentiment is this bad and everybody hates something this much, this is when you should really be taking a look at it. So here's India oil demand. It's risen 9.3%, 24 over 23, 2024 over 2023. It says India oil demand rose by 9.3% year over year to 20.428 million metric tons in November. Year over year changes: diesel up 8.5%, gasoline up 9.6%. It just goes on. Aviation fuel up 8.4%. So that's just India. I haven't got, dove deep into all the other small Indonesia and the Philippines and all these other places, Bangladesh, Pakistan. Then you have 1.3 billion people in Africa. So, um, yeah, I don't think that we're at peak demand. We probably are at peak demand in the West, in the OECD countries, but they represent, how many people out of the total population of the world? And most of the population lives in developing and emerging markets where energy inputs are increasing over time, uh, like in India. So I talked about this. This was going to happen with the AI centers. Everybody was focused on nuclear. I think down the line that becomes the ultimate solution, especially because I do believe geological fundamentals will press themselves on the economy eventually, where you're building all these LNG terminals and all of this natural gas fired possible production for energy, and all of a sudden, what if we're at peak natural gas in addition to peak oil? So it'll be interesting to see. Everybody just says, well, we basically just have an unlimited supply of this stuff. And so you have Chevron and Exxon are going to enter into data center energy supplies. I predicted this. I talked about it would happen. It's happening now. This is an article from uh, oilprice.com. It says Chevron and Exxon are both planning to venture into the electricity supply business to take advantage of the surge in demand expected to come from the proliferation of data centers. The majors would focus on natural gas plus carbon capture to ensure the supply is low emission. Reuters reported this week, citing company executives from both Exxon and Chevron. Exxon separately said in an update this week that it has plans to enter the electricity supply market in light of the expected demand boom from big tech majors as the race in artificial intelligence intensifies. Again, I've talked about this before. Gas is cheap currently. They need electricity. You can build these cogeneration facilities rather quickly relative to, say, a nuclear power plant. You can probably put them on existing facilities, like where your existing footprint on your refinery or something like that. These companies both have a lot of experience running cogeneration plants because they have them in their refineries and in their chemical plants. That's where you get your steam. You basically fire a natural gas turbine. The exhaust from that's very, very high temperature. It goes into what's called a heat recovery steam generator, basically a boiler. You extract further energy by turning the water to steam, which runs a steam turbine, generating additional electricity, and then you can use the steam in the process in the refinery for various processes that they need. So, and all of these plants have these things, so they know how to do this. Um, I knew this was going to eventually happen. They have the money, they have the wherewithal. Total's already doing that. They've kind of become this whole, not just focusing on oil and gas, but looking at the whole like energy ecosystem and seeing how they can tie that in, and at the center having like an energy marketing and um, trading business that can arbitrage or trade the various energies that they produce. So I think that's kind of the model to be successful. But as far as this AI stuff goes, this is the fastest way from, start to finish as far as new power demand. It has to come from natural gas cogeneration. And we see that is also happening, as I've talked about this before in previous slides. I don't own these companies, but I want to point it out to you where things are going. This is GE Vernova signs 9 gigawatts of gas turbine reservations in past month. GE, split up. This is the power systems all ended up in this GE Vernova. Um, this is where the wind power and the gas turbines ended up, aeroderivatives and heavy gas turbines for electricity production. So it says here, GE Vernova has signed 9 gigawatts of reservations for gas turbines with customers in the past 30 days. That's 9,000 megawatts, folks. GE Vernova Chief Executive Officer Scott Strazik said in an interview with Bloomberg this week, GE Vernova did not disclose any of the customers it had signed reservations for, but Strasnick noted that they include data center developers. Big tech names are moving to secure generation for their power-hungry campuses, with some facilities eyeing launch dates as early as 2028, Bloomberg reports. While business is booming on the gas side, I just wanted to throw this in there because it was in the blurb. GE Vernova also laid out some troubling indicators for the already struggling U.S. offshore wind industry. Quote, the reality is the economics of this industry don't make sense, Strazik told Bloomberg. That's the CEO of a company that makes offshore wind turbines. Again, the reality is the economics of this industry don't make sense. I think this thing's going to die in the next administration, offshore wind. Anyways, going on, it says the company said it is no longer seeking new sales for its offshore turbines in the US, and it hasn't sold one in nearly 3 years. So we kind of told everybody this was going to happen eventually, and here we are. Their gas turbine business is booming, and they haven't sold an offshore wind turbine in 3 years. There you go. And people are against this stuff. Whether I don't get into all the nuances and science of whales and the fish industry being affected. People just don't want to see these things offshore. And it didn't help when I think blade, blade or several blades came apart on one of these offshore things and washed up on the shore and killed wildlife and all this stuff. People don't want this, and this is why you see gas turbines booming. And that's going to do that when you have gas at $3 an MMBTU or less. So this is interesting. We kind of forecast this would happen. I think that this is another reason I'm still bullish on nuclear for this, because eventually, you know, if we do run into peak shale, both oil and gas, which some folks are saying we're heading towards, and gas prices rise, then you're right back where you started. If gas, even with all these LNG terminals, export facilities they keep building, at some point the arbitrage of low gas in the US and high gas in the rest of the world goes away, right? So even if the rest of the world comes down some and we go up, what does data center electricity generation look at $6, $7, $8 an MMBTU? Okay, I don't know. This is why long term, I guess in the short and medium term, you can be bullish on these cogeneration and natural gas plants. But, in the long run, all roads lead to nuclear. So I wanted to talk about China some more. Another thing that I think you see, I'm starting to talk more about these themes that I'm more interested in for 2025. Again, this is another thing where everybody that you talk to hates China. But if everybody hates it and everybody sold it and everybody's negative on it, then who else is left to sell? That's my first question. So here we are, and this kind of speaks to a couple things, right? This is the Morgan Stanley World Index, right, of country weights. And so you can see here the United States represents 66% of the world index, okay, for equity, 66%. China only represents 2.61%. So China's the second largest economy in the world behind the United States and growing. It's becoming, we've talked about it for the last several weeks, the manufacturing prowess, how they're moving up the value chain, how they're becoming more technologically sophisticated, all these different things. And yet Chinese stocks basically haven't went anywhere, right? Because everybody's negative on China. And I was listening to, it's a lot of it comes from the West from just the perceptions. Our media tells us a certain thing, so we believe it. If you don't, the average person isn't going to get it. They're going to do and understand and believe whatever CNN tells them. It's just the way it is. But in order to make money, it's again, do I want to buy a market, the US, that is historically overvalued and it represents 66% of the world index? That's crazy. And when I can buy the second largest economy in the world that's growing, that, it's not that it doesn't have problems. All countries have problems. But, you know, this idea that we're in this new dawn here in the US, it's not going to happen. We are in terminal decline. And I understand the euphoria around the Trump. I'll bet anybody right now, I'll put $10,000 in escrow that the Doge committee or whatever does not cut $2 trillion from the budget. It's not possible without going after defense and entitlements. And they are not going to do that. Okay. And so that's off the table. You're not going to get drill, baby, drill. And they can't do a fuerta like Milei in Argentina could because the wheels haven't fallen off yet here. Okay. And so you could reduce taxes, which they probably will. You can reduce regulations around the margin. I just saw today that, um, and don't get me wrong, I believe that the government should be cut. I believe that the post office should be privatized. I believe all these things. I believe entitlement should be reformed, that they're going to be reformed whether you like it or not, because it's going to get to the point, as I pointed out in my article that I wrote over 10 years ago about how Social Security and Medicare would destroy the United States as a political entity. Can't afford it. So there will be higher withholding taxes. There will be inflation. There will be cuts to benefits. There will be means testing. People say, no, there won't. They won't do that. It's a third rail. Yes, they will. They've already done it. They're not going to have a choice. It's going to be boiling the frog. And so what they should do is cut it off for a certain population, say no one's getting it after that, but here's what we're going to do. You know, um, create a system where you get money taken out of your check and it goes into whatever for long term. Okay. And you get a big, big tax advantage for that. There's a lot of things you could do. It's just a lot of people just have a lack of imagination on what could be done. But this isn't really going to work. And so I think a lot of the reality is going to set in fairly quickly. And it's going to be realized is already pulling back from, we're not going to deport 13 million people, whatever they were talking about. You already heard Trump talking about he's all for the DACAs. Okay. They're staying, he said. Okay. You're just going to see that people are going to learn again, if they haven't learned, or they're going to be disappointed because they actually believe what politicians say. Now, all these things I agree that they should do, but the problem with politics is they're not possible because most of the people in the Congress and in the bureaucracy don't want these things. And so it won't happen. Again, you don't have 4 years to enact your agenda. You have a year and a half until you get to the next congressional election. And if we're in a recession, or if they do all this crazy stuff and, cut back too much, you got to remember GDP involves government spending. And so if you cut all this stuff, if they go really wild, I mean, I hope they do, but I don't think that's what's going to happen. And so does the United States, being a bankrupt country, because it's bankrupt, it does have pockets of areas that it does well in. But does it deserve to be overweighted like this in the world index, 66%? That's my point. That's the argument I'm making. I don't think it does. It's overvalued and it's living on, a history, a previous reputation that no longer exists, like an old fighter, who is who is relying on, you know, this is like handicapping horses. Okay, it's not about looking at it like GDP and economic growth. It's like, okay, what can go wrong here and what can go right and what can be done here and what can be done in China. I mean, the problem with the United States is being a democracy and being all these different constituencies that all think that their idea or their particular thing that they care about is the most important. These are all competing factions. And so it's very difficult to get major change done. It's not difficult to make change in China. Xi just says he wants the stock market to go up. They'll just keep stimmies going until the stock market goes up. And if you don't believe me, well, I mean, what I've heard is, well, I have a real estate implosion that's going to take decades to uh, rectify. It's a communist country. It's in debt, blah, 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 blah. You know, all these things. And they're not going to do this. They're not going to do that. They can't do this. They can't do that. And in the meantime, we're seeing things happen where they're taking over industry after industry. Do I think there's going to be a trade war? Everybody's running around tariffs, tariffs. Nobody understands tariffs. There's not going to be a trade war. They're going to have a Mar-a-Lago Accord. Trump's a deal maker. You posture when you're deal making, when you're going to go into a negotiation. This is why somebody told me this once, and I try to follow this. Most people don't know what they're talking about because they've never been anywhere and done anything. They've never been in a negotiation. Okay. I like going and buying new cars. I like going in and wrestling in a negotiation and posturing and knowing what I want before I go in there and going prepared and then get to a situation where I'm happy. Okay. Most people dread that experience. I don't dread it because I know what I'm doing. And Trump knows what he's doing too. He's a deal maker. He's a negotiator. So he sets way out in left field expectations, knowing that he's going to pull it in to a certain point to get a deal. And that's what I think is going to end up happening. Yet you have everybody in the media running around, oh, we're going to have, these dumb people that voted for Trump don't understand that they. Okay, well, I think what you're going to find is there's going to be a deal be had because it's in nobody's interest to, have a trade war. Smoot-Hawley, 1930s trade. I could be wrong, but I doubt I am on this one. I just read the guy's books. I understand how his mind works. He wants to get deals. He likes to get deals done. Okay. But this isn't going to hold in my view. So speaking of China, they recently had a Chinese leadership has had a 2-day planning meeting in Beijing. We know they're going to do something, but we don't know what that is yet. So here's the article. It says Chinese leaders wrapped up a 2-day planning meeting in Beijing on Thursday with pledges to take a more proactive approach in pepping up the world's second largest economy, but gave no details on new stimulus measures. State-run TV report on the annual meeting mainly reiterated a strategy outlined earlier in the week after a session of the ruling Communist Party's powerful Politburo, at which leaders pledged to loosen monetary policy and adopt a more proactive fiscal approach. The CCTV report said China would raise its fiscal deficit and continue to issue super long government bonds to finance additional spending. It gives no details on the amount of money to be spent or size of the deficit. So I think that what we're going to see is China incrementally doing things, do a little bit more, QE1, QE2, just like we did here. And if it doesn't work, they'll do more. If it doesn't work, they'll do more. I think that's what we're going to see. And I think that you just saw even Trump, he invited Xi to his inauguration. Did you see that? I mean, that tells me there's going to be a deal. They're going to get a deal. It's funny. I was listening to somebody say, well, Taiwan, they're going to have a war. Taiwan is part of China. Everybody acknowledges that, just like Hong Kong was. Okay. It was funny because this particular individual pointed out that when Hong Kong went back to the Chinese, nobody in the ASEAN countries disputed that because they understood that it was a British colony that was taken from the Chinese during the Opium Wars and that it belonged to China. And the same thing is consistent with Taiwan. It's already, for the most part, every year that goes by is economically integrating itself back with China. Okay. There's already a lot of business. It's not like they're just sitting there with this 100-foot wall facing China and there's this enmity and all this. Believe me, there's, you know, up until recently, for some reason, everybody understood the one China policy. That these things are this these places fundamentally belong to China. Okay, so there's not going to be a war. There's not going to be an invasion of China. It's not going to happen. And those people that are going to push for it, these neocons and all these other people that have these, big ideas. But again, You don't see anybody in the ASEAN countries, maybe Australia or New Zealand, because they're mostly part of the Atlanticist hegemon. They might say something or talk about, Ch scary China and all this. It's like China's going to go down there with a bunch of amphibious landing tanks and just, drive through the place. If you've been to Australia recently, you'll understand that the place is flooded with Asians. What's the problem? So I think we're going to see a deal. I don't think there's going to be a war, but I don't think that the United States deserves the premium that it has over the rest of the countries of the world, especially China. I could be wrong. I could be talking my own book. I could be wishful thinking. That's all possible. So another reason why I think that, we're going to have some stimulus coming more and more from China. Why? China's deflation persists. GDP deflator was negative for past 6 quarters. You see that there's a deflation happening there. And so we'll see what happens. We'll see if they pump it up or not. Okay, if they understand what's happening. And I think they do have a lot of room to do stimulus. And I think that they're probably going to do it. So this is interesting in my book. It says U.S. stocks very exceptional relative to European equities. I think I might have showed this before, but um, I would not right now. Europe's on my radar screen, but until I see political change that is more free market, I think it's slowly but surely happening. I think the pendulum is swinging. The status quo is resisting the change, but I think it's happening. Um, until I see that change, and I'm not ready to buy these equities. But you see how much the U.S. has outperformed Europe, and that's been a deliberate policy of the, U.S. hegemon. Again, what did they say back when NATO was created? I think I remember the general's name, but he said the whole point was to, and it's worked marvelously. This policy has worked by these people. I don't agree with the policy, but it's worked. And the policy was keep the United States in Europe, okay? Keep Germany down and keep Russia out of Europe. And that's what they've been able to do. And so now you have, then we blew up Europe's gas pipeline from Russia, where it was getting cheap gas from. We made them divest themselves of assets there, um, cut off trade demonize this country that's a European country or has one foot in Europe. And then, they're out. We say, oh, by the way, we blew up your cheap gas pipeline that you're getting cheap gas from and buy our LNG at inflated prices. You see how this works? That's the policy. And so this says right here, it's not necessarily that the U.S. is exceptional. It's that, they have their foot on the neck of the Europeans, and the Europeans are such vassals and so cucked, if you will. I'll use the term. They just can't see it. Again, I'll say this again, when the historians write it 20, 30 years from now, I'll bet you $100 right now, Olaf Scholz had no idea the United States and CIA and MI6 were going to blow up that pipeline. They just did it. And what's funny about it is Joe Biden announced it before they did it. Remember the clip? Everybody said, oh, Joe, he just says stuff. Yeah, he says something, but stuff has come to fruition. And so until I see governments change there that are, we want, we're Europeans, we're not Americans. We want to have, we have to have a security détente with Russia and these other places. And we need to put policies in place to reform our governments and our policies that are pro-economic growth, pro-energy, like kicking the stoplight coalition out in Germany and turning nuclear power plants back on and reestablishing the gas flows. Until I see that, I'm not interested in Europe. Now, there are pockets there of things to buy. I mean, France is probably facing a fiscal crisis here pretty soon. It's totally out of control. Macron is using all kinds of chicanery and all kinds of things to stay in power. And, but eventually the people are going to have their say. They've had enough of these people and their nonsense. Okay. And I think one of the big catalysts is going to be eventually, I think, this war in Ukraine I mean, I don't know. I don't watch the mainstream news. I have no idea what they're telling you people, but I watch the reports from the battlefield and various Telegram channels, and the Russians are advancing all over the battlefield. I see these ridiculous things that, you know, I know people want to believe that Ukraine can win. It's impossible for them to win. They're not going to win. They're going to keep fighting until they can't fight anymore, and it'll be like in the Civil War when the Confederacy just couldn't go on, and so it ended. Same thing in World War One. The Germans just couldn't go on any longer, and it ended. And that's what's going to happen with Ukraine. And lines are going to start breaking down. They're to the point now where they're talking about you have the United States telling Ukraine that it needs to start drafting 18 to 25-year-olds. Well, if you look at a population dispersion of different age groups, there aren't that many 18 to 25-year-olds in Ukraine. They don't have the manpower, and the West doesn't have the military industrial capabilities to fight peer wars. Okay, because our military industrial complex is not set up for war fighting, it's set up to enrich the military industrial congressional complex and the people that are attached to it. And people point out the corruption in Russia. Yes, there's corruption in Russia. People have went to jail and been eliminated. Okay, and it continues to a certain extent, but it's rife here in the United States. And so, now you have, this, it's like the West has, and I think this could be a catalyst when this finally breaks and you see the Russians on the western bank of the Dnieper River, and they've taken Dnipro over and Zaporozhye and all these places, and they're sitting there, and people are like, well, how'd that happen? Now what are we going to do? Are you still going to keep listening to Macron and Keir Starmer and Ursula von der Leyen? Do you remember all the ridiculous comments? And hundreds of thousands of men have died, hundreds of thousands on both sides. I was watching the documentary that finally came out at the edge of the abyss about the Somali brigade, the Donetsk People's Republic militia that ended up being integrated into the Russian army, and it was showing the Battle of Mariupol from that perspective of the Donetsk militia, the Somali brigade. And at the end of the movie, uh, it showed like everybody that had been in that documentary is dead now. All those guys, they're dead. And it's even worse on the Ukrainian side. You have a 5 or 10 on artillery advantage on the Russians. They have complete air superiority. They're dropping fabs on everybody. And for some reason, you have these shills in the Western side that are telling everybody that the Russians have, incurred more casualties. Okay. Again, I look at reality. I look at logic, you know. And that doesn't mean I'm a propagandist for Putin. It's reality. And so I think that it could be a catalyst. Once this thing breaks and everybody goes, wait a minute, the truth's going to come out. Hey, you were telling us all along we were going to win. So there's already stages being set for blaming everything on Trump and the incoming administration. If they just would have kept giving us weapons, you can see it already. But, I don't think that this is going to continue. The Biden administration is trying to shove as much money as it can in there before it gets out of power, but the money taps are coming to an end. And they just don't have the men, they don't have the munitions, they don't have the ability to hold on. And so they have to go through this process. I heard somebody say this once. It's going to be a situation where the Europeans, the US doesn't even care about this anymore. The incoming administration does not have this war as a priority. Now, again, I don't think Trump's just going to walk away from it because he doesn't want to be accused of what he accused Biden of in Afghanistan, just walking away and it was a disaster. So, but I do think it's going to get unwound. And I think there's going to be a tremendous pressure on the Ukrainians to come to um, bring it to a conclusion and have to sit down and negotiate. And we've already seen from the Tucker Carlson interview of the foreign minister, Sergei Lavrov, that what the terms will be. And those terms right now are not going to be acceptable to anybody in Europe or Donald Trump. So I guess it will continue until they just, take over all the territory all up to the western side of the river. So we'll start there, I guess. So what I'm getting at is that could be a big catalyst if this thing falls apart, like I think it's probably going to eventually, uh, for some massive political, you need massive political change in Europe for it to be investable. I don't think it's investable right now, with a few exceptions here and there. So here is another chart. These are all from top-down charts on Substack. CRB versus US bonds. You can see that we've kind of been in this. This is going to come to a culmination of either we break higher or lower. I suggest that based on all the money printing that's going to happen around the world, that this is going to break higher, CRB versus bonds. I believe we're in a bear market. You don't want to be anywhere near fixed income securities, I think, going forward. We're 3 or 4 years into a bond bear market. You just don't want to be owning bonds. And I think that commodities are going to go higher. And I think a lot of this will be determined what happens with the oil price in 2025. If oil crashes, oil goes down, if drill baby drill works, and the oil price goes to, like, some people are talking 40, then, you know, this probably breaks down. If we're looking at a world recession, which I don't see how you're going to be in a world recession when the world central banks have been cutting rates for the last year at least. Those rate cuts now are starting to move through those economies. So we'll see. But I think that this is going to reach a point here, where this and that gets thinner and thinner and squeezed, and it's either going to break higher or lower. I'm not going to play Mr. Technical Analysis, Mr. CTA, but uh, this is something to watch. If this chart breaks higher, then you can expect commodities to move quite a bit higher. If it breaks lower, then you would expect commodities to go down. But again, I think you're going to see a culmination in this very soon. And I think a lot's going to be due to the oil price. So I wanted to talk about this because I found this interesting. I'm always coming across pieces of information that can lead to ideas. And this is from US Global Investors. They have that JETS ETF. So they talk a lot about airlines and the airline industry. It says commercial airline fleet is at record average age. So you see the median or the average age, long-term average is about 13.4 years. Right now we're at 14.8 years. And I think there's an opportunity here, not necessarily in the airlines or even buying the airplane manufacturers, but there's a lot of leasing companies and companies that have own engines and they refurbish parts and then they lease these things to airlines. I think there's an opportunity in some of these companies I've been looking at, but this is tremendous. I also, in my own private portfolio, it's not in the actionable intelligence portfolio, but I do own a couple of companies that own and manage different airports, especially in South America, in Mexico. Those have done well. I think they'll continue to do well. And also, one of the portfolio holdings owns a majority stake in the uh, second largest airport in India, which has been totally refurbished and continues to see growth in passengers. So I own a stock that as a holding company that holds things like that. So I think this is tremendous. I think there's going to be an upsurge in, when I've looked at some of these companies that lease, they're doing really well right now just because of the lack of availability of parts and engines and planes. And so I did see a news report that Boeing is ramping up production now again. So we'll see what happens. I think that they probably need to change some management there and fix some things, get away from the DEI and go back to an engineering focused management, but we'll see what happens there. But just something to keep in mind. Then this is again from US Global Investors. Record-breaking projections for global airlines in 2025, over $1 trillion in revenue and carrying 5.2 billion passengers. This will be record-breaking projections. So this is the kind of stuff when I see it, then I have to go back and go out and look and say, is there some way to, this is obviously an increasing trend. Why? Even in these emerging markets, as people get wealthier, they're going to travel more, right? So that's what we're continuing to see. That's what will continue to happen. So when you see stuff like this, you say, okay, is there a trend in place? And then I need to go out and find some vehicle that can take advantage of this that's reasonably priced if it's available. So something to think about if you are interested in understanding how I think about things and how I choose investments, or it's an idea for you to research also if you'd like. Okay, that's it for this week. Thank you for participating and coming here and listening to the videos. Again, please avail yourself of the Actionable Intelligence Alert newsletter. It's on Substack now. We also have a free version that goes out weekly. It doesn't necessarily have picks, but it's a curation of all the videos and podcasts and articles that I have been looking at for the previous week that I found interesting and that you might find interesting also. So that's all available at Substack. If you would, help me out with the liking these videos, sharing them. It helps in the algorithm, and I do appreciate it. That's it for this week. We'll talk to you next week. Thank you.